The last time gold fell during a war scare, it was the setup for the biggest rally in modern history. Right now, headlines are screaming that gold is dropping because of the Iran crisis. Silver just fell back to December 2025 levels. Gold is off its highs despite a shooting war intensifying in the Middle East. And the financial press is treating this like a mystery. It is not a mystery. This has happened before, and if you know your history, you know exactly what comes next. Let me take you back through 3 periods that look almost identical to today, and I will show you the specific price moves, the timelines, and the pattern that keeps repeating every single time the world tells you gold is broken. We start in 1973. The Yom Kippur War breaks out in October. Egypt and Syria launch a surprise attack on Israel. The Middle East is on fire. Sound familiar? Here is what gold did in the February 1st weeks of that conflict. It dropped. Gold fell roughly 8% in the opening days of the Yom Kippur War as investors scrambled for dollars and liquidated everything. The prevailing wisdom was that the dollar was the real safe haven, not gold. That narrative lasted about 3 weeks. Then something shifted. OPEC announced its oil embargo on October 17, 1973, and gold began one of the most violent upward moves in its entire recorded history. From its October 1973 low of around $95 per ounce, gold climbed to $195 per ounce by the end of 1974. That is a 105% gain in roughly 14 months, starting from a war scare sell-off that looked exactly like what we are seeing today. But here is the part almost nobody talks about. That 1973 to 1974 gold rally happened while the US federal funds rate was rising aggressively. The Fed was hiking, inflation was running hot, real GDP growth was collapsing toward negative territory, and gold still doubled. Today the Fed funds rate sits at 3.63%, US real GDP growth is 2.1%, and gold is already at $4,034 per ounce. The macro ingredients are not identical to 1973, they are arguably more combustible. Now let us move to 2007 and 2008, because this parallel is even more uncomfortable. In the summer of 2007, gold was trading around $650 per ounce. By March 2008, as Bear Stearns collapsed, gold had already surged to $1,011 per ounce. That is a 55% move in under 9 months. But then came September 2008 and the Lehman Brothers bankruptcy. Within weeks, gold dropped from around $900 all the way down to $712 per ounce. A 21% crash. During a financial crisis. During the single most fearful moment in modern financial history, gold sold off hard. And every analyst on television said the same thing they are saying today: gold has lost its safe haven status. Gold is broken. Gold is not working. What happened next? From that $712 low in October 2008, gold climbed to $1,921 per ounce by September 2011. That is a 170% gain from the point where everyone declared it dead. The crisis sell-off was not the end of the gold story, it was the beginning of the most powerful chapter. The reason is almost embarrassingly simple. When a crisis first hits, institutions sell gold to cover margin calls and raise cash. That is mechanical selling, not a judgment on gold's value. Then, once the dust settles and governments respond with rate cuts and money printing, gold catches the full tailwind of every dollar that gets created. Which brings us to 2020, and this one should hit close to home because it happened in living memory for most of you watching. In February and March 2020, COVID-19 panic gripped markets. Gold dropped from around $1,680 per ounce to $1,477 per ounce in the space of 2 weeks. A 12% crash while the world was ending. Same story. Institutional margin selling. Panic liquidation. Gold is broken. You have heard it before. The Fed then cut rates to essentially 0% and launched $3 trillion in emergency asset purchases in the space of a few months. By August 2020, gold hit $2,089 per ounce, an all-time record at the time. That was a 41% gain from the panic low, achieved in under 5 months. Now here is where today gets really interesting, and where the historical comparison takes a sharp turn. In 1973, gold started that rally from $95. In 2008, it started from $712. In 2020, it started from $1,477. Today, the baseline is $4,034 per ounce. We are not starting from a cheap asset. Gold has already priced in a significant amount of fear. So does that mean the pattern breaks? Not necessarily, and here is why. The June CPI data just confirmed that grocery prices are still climbing even as gas prices fell. Core inflation, which strips out food and energy, is still running above the Fed's 2% target. That is exactly the kind of sticky inflation that defined the 1970s second wave, the period from 1977 to 1980 when gold went from around $135 per ounce to $850 per ounce. That final leg of the 1970s gold bull market, the leg that most people missed because they sold too early, represented a 530% gain in just over 3 years. The trigger was not the initial inflation shock. It was the realization that inflation was not going away. The Iran conflict intensifying right now is putting upward pressure on oil, which flows directly into transportation costs, which flows directly into grocery prices, which flows directly into the CPI number that the Fed has to respond to. If oil spikes from an Iran escalation and reignites the inflation that the Fed thought it had tamed, we are not looking at a 1973 parallel anymore. We are looking at a 1979 parallel. And in 1979, gold did not correct and recover. It went parabolic. So why is gold falling right now if the macro setup is this explosive? The same reason it fell in October 2008. The same reason it fell in March 2020. Large institutional players are raising cash. Risk off does not mean buy gold first. It means sell everything first, then buy gold once the smoke clears. Silver falling back to December 2025 levels is actually a confirming signal, not a bearish one. Silver almost always drops harder and faster than gold in the initial panic phase, then outperforms gold significantly in the recovery. In the 2020 recovery, silver went from $11.77 to $29.24 in 5 months. That is a 148% move starting from a moment that looked exactly like what we are watching today. Here is what history is telling you right now. Every single time gold has sold off during a geopolitical crisis combined with sticky inflation and monetary policy uncertainty, the sell-off has been temporary and the subsequent rally has been larger than the move that came before it. Not once, not twice, but every time across 5 decades of data. The question is not whether gold recovers. History is not even ambiguous on that point. The question is whether you are positioned before the institutional money rotates back in, or after. If you want to see this kind of historical pattern analysis every single day, not just when a crisis makes the headlines, subscribe to this channel right now. Every day we break down exactly where gold, silver, and the macro data are, compared to the historical setups that preceded the biggest moves. We will tell you what the pattern says before the mainstream press figures it out. Hit subscribe, turn on notifications, and join the thousands of people who are not waiting to be surprised by history when it repeats itself again. The next crisis move in gold could come faster than any of the historical examples we just covered. When it does, you want to already know the pattern. Subscribe now so you never miss the analysis that gets you positioned before the crowd figures it out.